Why do investors become more impatient over time? At first glance, experience should increase patience. But in many cases, the opposite happens. As time passes, investors often become more reactive, more restless, and less tolerant of waiting. Here's what behavioral finance and neuroscience suggest. 1. Hedonic adaptation. Returns stop feeling exciting. The concept of hedonic adaptation, popularized by psychologists like Daniel Kahneman, explains that humans quickly adapt to gains. What once felt exciting becomes normal. Early in the journey, 5% growth feels meaningful. Small wins create motivation. Later, gains feel expected. The emotional reward shrinks. When emotional reward declines, impatience rises. The brain starts craving stronger stimulation. 2. Dopamine tolerance. The brain wants more stimulation. Repeated exposure to market movements, volatility, and short-term gains trains the reward system. Neuroscience research on dopamine suggests frequent checking increases reward sensitivity. Over time, the same stimulus produces less excitement. The brain seeks stronger or faster feedback. This creates a cycle. Check small reward adaptation, boredom, need for action. Patience becomes neurologically harder. 3. Rising expectations over time. The longer someone invests, the more expectations grow. Early stage. I hope this works. Later stage. It should be working by now. Expectation inflation creates internal pressure. When reality moves slowly, the gap between expectation and progress increases frustration. 4. Opportunity cost awareness increases. Over time, investors become more aware of alternatives. That asset is rising faster. I could have switched. Others are outperforming. Behavioral finance calls this regret aversion, a concept explored by economist Richard Thaler. The longer you stay in one position, the more you imagine missed opportunities. More comparison, less patience. 5. Information exposure intensifies. With time, investors consume more financial news, social media opinions, performance comparisons. Increased information increases perceived urgency. Constant exposure creates the illusion that something is always happening, I should respond. Silence becomes uncomfortable. 6. Compounding is invisible in the short run. Compounding is nonlinear. In early years, growth appears slow. Progress feels flat. Only later does acceleration become visible. But because humans think linearly, they expect visible, steady progress. When growth doesn't feel exponential yet, impatience grows. 7. Identity shift, from learner to controller. In early stages, investors accept uncertainty. Later, experience creates perceived expertise. With perceived expertise comes higher desire to intervene, stronger opinions, lower tolerance for randomness. The illusion of control increases over time. And when outcomes don't match expectations, frustration follows. The core psychological mechanism. Investors become more impatient over time because emotional rewards weaken, expectations increase, comparison intensifies, dopamine sensitivity changes, control illusions strengthen. Slow compounding feels unsatisfying. Time doesn't reduce impatience automatically. Without conscious structure, it amplifies it. Practical implications. To protect patience. Reduce frequency of checking. Predefine time horizons. Measure progress yearly, not daily. Limit comparison exposure. Revisit original thesis regularly. Patience is not natural. It is engineered.